Hi, welcome to the Red to Black podcast. Here, you will learn how to invest in highly profitable private businesses to create abundant financial freedom. If this topic interests you, we invite you to subscribe to our channel. This podcast is hosted by Werner Minchell, ex-Marine aviator and current real estate investor, and Mario Parzino, current Marine infantry officer and business investor.
Hey, good evening, Warner. How are you?
Oh, I'm doing great. How are you doing this evening?
Excellent. How was your camping trip up to the Bighorns?
It was actually really good. We went to the Southern Bighorns and we found a really cool camping site. I'm not going to say the name to keep it a secret because the Bighorns is a huge area and there's so much to do there and it's really spread out. And I would say it's still an untouched national forest. But beyond that, it was phenomenal. We camped under some evergreen trees in a beautiful location with maybe only 6 to 8 other camping spots. And it was just a really nice time. What about you?
I just want to say there's some quiet gentlemen up there in the Bighorns who have nice spreads and good elk hunting properties, and there's some old quiet money up there. Yeah, Hawaii's excellent. Warner had a beach day today, did a little fishing. Ready to crank on this podcast. What are the topics for discussion tonight?
Okay, thank you for asking. The topics of discussion are what is investing, its cash flow. Number 2, what is appreciation? Number 3, focusing on cash flow leads you to value investing. Number 4, focusing on appreciation without cash flow leads to day trading and other schemes. Number 5, behavioral economics. Buy value today and patiently wait for appreciation later. And then finally, number 6, behavioral economics, more money today, abbreviated MMT. So, Mario, what are your thoughts on what is investing its cash flow?
I would say, in my mind, it comes down to 2 words: price versus value, or price value. Price is what typically it's flashing up on the screen. Price is what people is getting people's eyeballs. Value is what you do on the deep dive. Value is the due diligence. Value is what you actually are buying. Price is what you're paying. Value is what you're actually obtaining or receiving from the business. And that's the value is what's going to lead to the cash flow. Those are my initial thoughts.
Yeah, so those are great points. To add to that, breaking it down into performance, value is really looking at what an investment is going to pay you. So let's say you invest $1,000, the investment pays you $300 a year. That's a 30% return on your money. That's a great investment. So at its core, any business that's operating efficiently, that business is focusing on creating cash flow to its potential investors and to the company. So what are your thoughts on that?
I think those are excellent points, Warner. Value is exactly what you said. It's what's actually going to return you money. Price is what people are attracted to, especially if prices are going up. I'm of the mindset I want prices to go down. I want the price of the business to constantly go down because I can buy more of it, or I can buy more of these businesses. If the price of the businesses are going down, that doesn't bother me. As long as the earnings, the underlying economics, the earnings of the business are going up, that's an easy way to start making huge strides in your wealth.
Yeah, I think that's a challenging point for most people because most people are thinking about investment. Oh, the price has got to go up all the time. And when you say to someone, no, I want the price to stay the same, that blows people's minds. It actually blew my mind when you talked to me about that for the first time, which was probably 8 years ago. And it probably took me about, I don't know, 2 years to really figure out what you were saying. It was really an eye opener for me when I understood that no, I want that value to stay low so I can purchase that asset at a low price, because when I purchase it at a lower price, then my return on invested capital is much larger. It's a really, really great principle if you abide by it.
So let's break that down for the listeners real simple. Let's take almost the most simple business we can think of as a fourplex. If we lived in a neighborhood, let's say Raleigh, Durham, Chapel Hill, etc., Wilmington, North Carolina, and we were just going to buy fourplexes in this one area, and we could buy at the current rates, we could buy one fourplex a year, and we could do that for 20 years. So at the end of 20 years, you had 20 fourplexes. If the price went down by 50% every year, or it just went down and maintained that for 20 years. At the end of 20 years, instead of having 20, you'd have 40 fourplexes. You would double the amount of fourplexes you could afford to buy every year. Now, at the same time, this would be miraculous, but if you could, at the same time, you had negative pessimism reaction to the fourplexes, multifamily real estate fourplexes. You had this downward pressure on prices, but at the same time, people were optimistic about being renters. They went, I don't want to own, I want to rent. And rents were going up. That for that 20-year period, you were catching this wave of rents going from $500 a month to $750 a month to $1,000 to $1,200 to $1,500 to $2,000 a month. You would get much more. You would get far better results if prices for the property was going down and the value or the underlying economics, the rents were going up, than if values were going up and rents were staying about the same or just growing with inflation. It's hard to wrap your mind around, but break it down to a very simple business and think about it in a long period. If you're not selling, you're just going to be buying. You're going to be acquiring assets. You're going to be purchasing assets. You actually want the price over a long period of time to go down, but the underlying economics to go up. Over to you, Warner.
Yeah, I think that's a fascinating point because if you look at today's current environment, the investor psychology is real estate prices are always going to go up. And that's not how it's always been. So to have an environment where you have an investor psychology where let's say the majority of investors are like, I'm never touching a real estate again because I got smoked in 2008. And let's say in the future again, I get smoked. And the majority of investors are saying to themselves, I got cleaned out last time. I'm not touching real estate ever again. That's a huge opportunity for me as a real estate investor, my wife, for you, for anyone else who's interested in real estate and understands the underlying value. Because as you said, I'm saying, wow, prices are going to be going down. I'm going to buy real estate. But yet at the same time, the renters are saying, well, I'm not going to buy a house because I got cleaned out and interest rates are through the roof. So I'm just going to rent. Those are two of the best scenarios for real estate that I could see in the future. Great points.
I would say right now what we're seeing is single family houses there's people optimistic about single family houses right now. There's a lot of money flowing into single family houses. At some point, that tide's going to change. People are going to realize there's enough information flowing out into the universe. People are going to realize a single family house is a horrible, horrible investment. And there's going to be oversupply and a lack of demand. Eventually, people are going to realize these are massively expensive investments, quote unquote, lifestyle investments to maintain. I'd be far better off being mobile and moving and renting than owning. And the price is going to crash. Eventually, it'll return to its underlying economics. In the short term, all assets are a popularity contest in the short term. In the long term, they're on a scale. They're being weighed on a scale. And single family houses are lacking in one critical aspect that we're going to keep hammering again and again and again on this podcast. They don't produce cash flow. Yes, is there appreciation if you hold a house for 20 or 30 years? If you buy really good real estate on, next to water, people like to live by lakes. They like to live by rivers. They like to live by oceans. If you buy really good real estate, single family house, over 30 years, it will appreciate, but you're not getting cash flow off of it. In fact, it's taking cash flow away from you. This is going to change. We're going to put this down, 2021, this podcast happened. We're going to watch, and eventually time will prove me to be correct. Eventually they'll be giving houses away because it's a lifestyle investment. And again, for the young guys listening, have a dream to own a beautiful house. Both Warner and I love houses. We love to have wonderful experiences cooking meals together. We love beautiful houses. Make it a rounding error in your total investment portfolio. When you buy a house, make it like a yawn. It's just a tiny little expenditure in your life. You don't even think about it. It's not an investment when you're talking about businesses, multifamily real estate, publicly and private traded equities, etc. Over to you, Warner.
Yeah, to finish out that point and move on to the next point, it's what we're saying is how much cash flow is coming towards you. So you invest money, how much cash flow is coming towards you. The best environment is prices that are staying low and returns, revenues that are going up with a huge delta, which is your operating margin is big, 30 to 35%. And then as those revenues go up, it's just getting bigger and bigger. It's a great situation to be in. And that you can only be in that situation if you understand the underlying values of a business and the fact that that business pays you to own it. So moving on to the next point, the counter opposite of that is appreciation. What is appreciation in your mind, Mario?
Appreciation is chasing popularity. It's chasing behavioral economics. It's chasing optimism. Right now, we see this with non-fungible tokens, NFTs. I guess they're these art pieces of art that are digitally tracked on the blockchain. We see this definitely with cryptocurrency. The underlying value of these is very difficult to pinpoint, and it really should be, speaking to cryptocurrency, it should be valued based on its utility, not its scarcity. Going into NFTs, I can see like Disney. Disney has the world's largest portfolio of digital intellectual property that can be licensed for other people to print on shirts, on sweatshirts, on cups, on thermoses, on lunchbox. So they've got all these little characters and they license them out and make a great return on these little characters. There probably will be something like that in NFTs, but you'd be far better off evaluating the clearing market or the clearinghouse for those NFTs than actually investing, trying to predict which little NFT is going to be popular and people are going to pay to license it. So again, it's a popularity contest. These assets, quote unquote assets, cryptocurrency and NFTs, and I'll throw in tulip bulbs. These are popularity contests, and it's very difficult to figure out who's going to be popular 20 or 30 years from now.
Yeah, and what you'll find is a lot of the individuals that are pushing up, say, the tulip bulb craze or the NFTs or any of these other schemes or manias, these individuals or most of them are getting out when the mania starts going down the mountain on the other side, starts crashing. And what I mean by that is the individuals that start it are getting out while the other ones are getting in because of that fear of missing out. So that popularity is a lot of it's run by fear of missing out because people they want to make this quick buck. They're not focused on the underlying fundamentals. It's all about not setting up a foundation for performance. It's about getting what I want quickly. What are your thoughts on that?
You brought up an excellent point, Warner, about the real value, or the people that are making the most money are actually exiting the position to more optimistic people. There's a particular wine merchant in New Jersey. I'm not going to mention his name. We both respect his work when it comes to marketing, and he's got a great brand, and he's a hardworking guy, and he's going to do great things. Right now, he is selling NFTs into the market. I think they're going for about $6,500 to $7,500, and he's sold over 250 of these. So he's cleared over $1 million minus his expenses, setting up a web page, etc. He's over $1 million selling. I think there's 268, maybe 270 NFTs, and he has a vision and he's selling it. He's doing a great job, but his position is a net. He's selling it to people that are more optimistic than him. He's actually exiting the position. He's selling the position. A lot of these guys that are the most vocal about cryptocurrencies are actually selling the position. They're not taking dollars and putting them to crypto. They're taking crypto, selling them into the market, and getting dollars. So that was an excellent point about look at what the guys are actually basically taking advice from a barber about whether you need a haircut is a horrible person to get an opinion on because he has a vested interest in selling. Yeah, you could use a trim up, and that's what you're doing when you're watching YouTube or you're looking at these popularity contests. A lot of the most active and vocal voices that you're experiencing or you're taking in or you're bringing knowledge from are actually on the sell side. They're not on the buy side. So just be aware of that, gentlemen.
Yeah, that's a great point. It's it's a great point because you're not going to know what side you're on unless you understand the underlying fundamentals of a business. If you understand the underlying fundamentals of a business, then you'll see a mania from far out. And at times, I'm telling you, manias have caught me. I mean, I'm thinking, wow, maybe I should get in the NFT. Maybe I should get in the Bitcoin. But then I always remind myself, no, wealth is created over 20, 30, as you've said, 40 years. And it's created by putting in this foundational building block, like we talked about in the past podcast, earning money, saving money, and reinvesting money, and doing that over and over again. And the only way you can grow your money is by investing in businesses that pay you to own them. Now, I got it. You can get an appreciation, make a lot of money, but that's not a long ball game, because at some point you're going to make a poor bet with all your money and you're going to lose the majority of it, because you're setting yourself up with the appreciation game to make bets based on popularity, fear of missing out, looking good. Oh man, this is just so amazing. I've never seen anything like this before. Whatever you tell yourself, that's the story with appreciation. Value investing based on fundamentals will always self-check you in terms of getting caught in this game of appreciation. How do you keep yourself from getting caught in this appreciation game?
Checklist, Warner. I have a very detailed, methodical approach before I'm going to put money to work. And it's got to pass this test, which is layers and layers deep of due diligence and checklists. And it prevents me from making wild decisions. I mean, we all can fall for this. NFTs, they actually they're very much interest me. But then I go back to, why wouldn't I buy Disney if I was so into NFTs? This is proven. These are proven non-fungible tokens that could be traded over the blockchain. Every one of those Disney characters could be traded over the blockchain. They could license them. Anybody could use the Disney chain. Anybody in the world. Now, right now, if you wanted to go license, I think they have Star Wars as one of their properties. You're going to have to sign a pretty big contract. It's not going to be this one-off little tiny contract, but they could easily put Star Wars onto the blockchain, and you could use it on an individual basis, 10 uses, or any type of use on your website, and they just get a little tiny fraction of the advertising revenue you're drawing on your platform. But that's a much sounder investment to look at who's already the winners and how much money are they making. Let's weigh that. Let's weigh that decision versus chasing potential winners and optimism and popularity. That's a fool's game. The wise man, what the wise man does is he weighs out that decision with a checklist, and he looks at how many of these have won, what's their record, what's their track record going back 20, 30, 40, 50 years. How many of these little characters do they win? They win a lot of them. You're going to be hard pressed to find a better business if you're into digital characters than Disney.
So, how I think about this is, why would Disney put their character on the open market? My opinion is they wouldn't, because that character generates so much cash flow. Why would they enable someone else to buy it unless they were selling that entire business to another business? Now, they may put a derivative of Disney on there with very, like you said, very strict stipulations of what you can and can't do with that. But they're never going to put Disney, in my opinion, into a digital space and allow someone to buy and have rights to that. Now, why?
There's going to be massive restrictions. So you can buy, if you want to print off sweatshirts in China or Sri Lanka or Vietnam with Disney characters on them, you can buy a license that allows you to use the licensed Disney characters on your sweatshirts or your thermoses or whatever you want to sell with a Disney character. You're right. When they actually want to license this to individuals, they're going to be very restrictive of how you use it. You can't use it that tarnishes the brand. And there's going to be some brands that they're not even going to do that. They have so much value in those brands, they're not going to license it out to individuals. But that's a much closer business to what NFTs should be traded at, is really the value of what is this worth to people to license it. So if somebody owns this NFT or this brand or this digital character, what are they willing to pay for it? And what's the history on that? These nonsense pieces of artwork that are selling for thousands of dollars, are not going to weigh out in 20 or 30 years as much as the Disney characters that are proven, that have massive intellectual horsepower behind them.
Yeah, because there's a business model behind it, and that's what people are forgetting. What the wine merchant is selling and all these other individuals who are selling NFTs, they're selling this digital art based on a craze, but there's no business behind it. So if there's no business behind it, what you're getting is the popularity, as you talked about, of the market. And that is not a strategy for creating insane amounts of wealth in your life. What's a strategy is our next topic, which is focusing on cash flow leads you to value investing. Would you mind speaking on that a little bit?
Absolutely. When you're weighing decisions based on past cash flow, current cash flow, and projected future cash flow, when you're weighing your decisions based on strictly the cash flow this business is going to generate for you over an indefinite holding period, you're making a very rational decision, and you're valuing each business individually based on its return back to the owners of the business. You're not speculating on popularity or optimism. When you're day trading, or when you're looking out in the horizon and going, can I sell this to a more optimistic person than I am right now? Can I sell this to someone that's going to be more optimistic next week, next month, next year? That's speculation. That's just speculation. It's guessing. It's guesswork. The wise money is always doing the hard work. They're doing the nug work to walk through the financials and diligently look at what does this generate. And not only that, but can this company raise prices every year? Do their customers like it when they raise prices? And that sounds crazy. Like, that sounds, what do you mean? Nobody likes prices being raised. Oh yeah, Rolex wearers love when Rolex raises the price. They love to own a Rolex for 10, 20, 30, 40, 50 years, and the price keeps going up. I go in, there's two brands, and I'm not going to mention their name because it's inappropriate at this point. There's two brands in the fishing world that, let's say, have a very consumable product that's worn definitely on offshore fishing, and they raise the prices every year. I've watched these for years and years. These two businesses, and they're competing in the exact same space, and there's not that many players, and it's really a commodity that they're selling, but they have a brand. They have a beautiful, well polished brand, and they raise their prices every year. And the guys that use this equipment love the fact that it's more expensive every year. It's status. There's a secret sauce to it. That's value investing. NFTs, cryptocurrency, companies that don't even make a profit that are selling for billions of dollars. They're publicly traded companies that are selling for billions of dollars. These are fools investments, and all you can do is get in and get out. And there's people making lots of money. There's people bragging and showing their wealth and their new Lamborghini based on speculation. They got in, they got out. Holding these assets for too long, it's going to be very disappointing for the guy holding the bag when the tide rolls out.
Yeah, so that takes us into the main point of this third topic, which is it's all based on performance. And performance is based on fact, and fact is based on the numbers. That's what we can all agree on in the world is fact. We can't agree on emotions. We can agree on fact. We can agree on numbers. So when you're looking at a business, how do you avoid getting caught in this appreciation game? You ask yourself one simple question. If I invest money in this business, will it pay me to own it? Does this business, at the end of the day, at the end of the year, do they actually take money from the items they've sold, deducting their expenses, taxes, everything else? Do they actually take money and put it into their coffers? That's straight up, straight line performance. And not many people are asking that question because their mind has been blindsided by fear of missing out, by appreciation, by this idea that someday it's going to make money. I think that's what the biggest thing that gets most people is someday it's going to make money. And the question I know you always ask, Mario, is, well, when is it going to make money? When is it going to make money? Okay, you say someday. Well, give me a date. Give me a completion date by when it's going to make money. And they'll say, oh, well, someday they're working on it. They're getting together. Well, why can't they just make money from day one? I get it. Like you and I are starting a podcast and we're not making money right now, but we're not raising money from other individuals or deceiving other individuals to give us money, saying someday we're going to make money. We're putting our own sweat, sweat equity and money to build it to a point where someday it will make money. But we're not. The key is we're not asking for investors, because that's irresponsible of us to do that. And the key is if you could talk about that a little bit more, is performance.
Yeah, let's get into performance. Before we do that, I'll just say that this is a venture, and there's something called venture capital, and venture capital is highly risky, and it's a whole different game. We're not encouraging people to get into it. It's not a game that you and I practice very often. We've decided to form a partnership in Wyoming and start a small venture, and the amount of money that you've put in, Warner, is a rounding error in your total net worth. The amount of money I've put in is very insignificant in my total net worth. So we are pursuing a venture together, but it's not an investment. It's simply a strategy to move forward and do business together. There's all sorts of venture capitalists out there, and they have to get exceedingly great deals on these businesses, and they know that 9.999% of them are going to fail, or 9.9 out of 10 are going to fail. And that one that they get every one 0.0001 that actually happens out of 10 investments is going to make up for all the losers they've had. It's not a very, it's a game it's based on relationships and location and access. It's not a game we're into. So that's venture capital. What I like to see is a business that is raising capital. That is why do they need to raise capital? Like what's the rationale? There's some good reasons to raise capital. They can't meet, their performance is excellent. They're meeting their goals. They're making money, but they can't meet the current consumer or customer demand for their product without some extra capital. They need to grow. They don't have enough to do this. They need to buy a big piece of machinery. They need to make another big plant. They're going out and they're saying, we have sustained customer demand and we can't meet it all. Our product is flying off the shelves. We can't actually keep up with the consumer demand. And we'd have to wait 3 years to get the X amount of dollars to buy this big factory or to put all this machinery in it. That's a great time to go out, instead of going to the banks and raising debt, is to go out and do equity deals. We're going to go sell. We're going to go do a fundraising. We're going to do 5 million fundraise. We're going to do another 5 million, another 5 million. That's an excellent reason to raise capital. When a business is not making money, they're saying, well, someday I'm going to make money. Someday, eventually, Tesla is going to be profitable. It's like, man, it barely makes money. And if you've tried to sell cars at $80,000 and 60 and 40, and now we're scraping by on $30,000 cars, and it's still like, when are you really gonna pay a dividend? When are you actually gonna make your shareholders wealthy based on your performance and not price appreciation? That price appreciation game it's just optimism and a popularity contest. At the end of the day, that's almost impossible to predict on a long-term basis. Over to you, Warner.
Yeah, those are great points. And to add, as we go back to performance, you talked about raising equity for a certain, let's say, certain business. It's got products flying off the shelves. Those investors, if they're smart, they're going to come in and look at that business and go, hey, what are your current cash flows? What are your current expenses? Okay, you say there's this insane customer demand. How big is your potential market? They're going to do all this analysis based on performance before they even invest. And that analysis is going to be based on their future potential of making it a return on their investment from the cash flows. That is essential to any business. And when you don't focus on the cash flows and you just focus on appreciation, you throw risk out the entire window. And that's what those equity investors are going to do. They're going to assess their risk. What if I don't get the customer demand when I invest? What if the management steals my money? What if they funnel it somewhere else? What if they mismanage the building of that factory? There's so many things that are involved, but those are all the right questions to be asking as an investor. Okay, how is this business run? What is the operating margin from the get-go? Okay, we're a little behind on that operating margin because we're putting more money back in the business. I get it. In the future, in a year, okay, we're going to be back on track. These are all assessments made on the underlying performance of a business. But when you throw that all out the window and you focus on appreciation, you just thrown all your risk assessment out the window. And I bet you, if you ask most people that are investing based on appreciation, I guarantee you they don't know the underlying fundamentals of the business. And that takes us to our next point, which is doing a little bit of a deeper dive into appreciation. Can you talk to us when you focus on appreciation? And we've been talking about this a bunch in this podcast. What road does that really lead you down?
You're starting to try to predict behavior. It's behavioral economics. It's not microeconomics. Value investing is all about the underlying economics of a specific small business or business for that matter. Appreciation is about behavior. That's what it is. It's about behavior. It's about trends. It's about popularity. So you're trying to predict human behavior. I think there's areas like commodities, like oil, where you can get data and you can start looking at consumption and storage, like annual data sets for the amount of storage in a commodity. And you can make a reasonable bet, but it's still a gamble. You're gambling. When you look at the underlying fundamentals of a business, you're valuing the business, you're weighing the business, and it's not a gamble, it's an investment. So that's the kind of separation. I would say one is behavior and one is weighing the value of a microeconomic situation.
Yeah, those are great points. It's really the difference between performance and behavior. And when you're focused on behavior, the amount of variables and behavior, there's not one person on the face of this earth who's been accurately able to forecast certain types of behavior. They can see from the past different cycles of behavior, but to really forecast it down to this price of this company is going to trade here at this day, it's impossible. And what that will lead to is day trading, Bitcoin, NFTs, and all that's based on is like, well, hey, it's going up. Like we had a friend on another podcast say, hey, over a 4-year period, you can't lose in Bitcoin. But they never ask the question, well, what if I'm not in for 4 years? What if I'm just in for 3 months? What if I'm in for 6 months? What if I'm in for 2 months? What if I'm in for 2 years? If you take an average out over a long enough time period, you can fool anyone. But when you actually look at the underlying fundamentals and the shifts of Bitcoin from 30,000 to 60,000 back to 30,000, that's not a stable, quote, investment. What are your thoughts on day trading, Bitcoin, and all this stuff that's created out of this frenzy of appreciation?
There's been one successful investor that has a 20 or 30 year track record. It's over 30 years. It's a 30-year track record. Day trading. One guy. He's in New York City. I'm gonna say his name is the Robin Hood or Mr. Robin Hood. Mr. Robin Hood has not made that money trading stocks. He hasn't made that money. The majority of his money has not been made day trading businesses. He's made that. I'm not going to say he's even a day trader. He's a trader. He trades. He makes trades, and he's doing that in very specific niche situations, workout situations, very specific situations where he has a data set. He has extremely unique knowledge about the situation. It's not publicly traded knowledge. It's not illegal what he's doing, but he has a data set. He has very specific information that allows him to make day trading an investment based on his information. That's very unique. Most people who are day trading are looking at momentum, and they're it's almost like they're using charts and wacky science to try to predict price movement and behavior. And nobody's had a 30-year track record of day trading. It's never happened. The traders that do make money, again, I can point to one guy that I know of, that I've researched, that I've listened to, that I particularly think he's pretty smart. Mr. Robin Hood. He's not gambling with his money or his investors' money. He's making very shrewd investments based on commodity prices and information that he has that nobody else has. That's a super niche place. And if that's you, this podcast isn't for you, because Warner and I aren't smart enough to create data sets that nobody else knows about. We're much better. Our talents in this, the God-given talents we have, are much better at weighing businesses and then growing those businesses, expanding the brand, taking that brand from a little regional brand to a state or local brand to a regional brand to a national brand to a global brand. That's our bread and butter. That's why we can predict much better than popularity contest or super deep dive on data sets with very limited publicly traded information. Those are kind of my initial thoughts, Warner.
Yeah, you can imagine the amount of effort it takes to put those data sets together. I mean, a lot of these individuals that are doing it, they're spending a lot of time and effort putting these data sets together, going down these paths, and I think it's misguided because there's this thought like, well, I can always be making money off the cycles. I can always be making money off of behavior, but they've swapped behavior for underlying fundamentals. And if they just, Warren Buffett talks about this. He's like, if you're just willing to wait, he says his greatest asset is not his smarts, it's his temperament. And what he means by that, it's his ability to patiently wait for great opportunities. And I saw a video of him recently. I think he was talking to some business school students. And he shared with them how he's just made money by being in the right place at the right time, by simply just waiting for businesses trading at really cheap prices. He gave this example of when he first started buying businesses. He was selling, I think he was a stock broker, and he was selling stocks in his local town where he lived. And he went to one guy who worked at this insurance company. It was a colleague of his or a friend of his, and said, hey, do you want to buy this stock? It's trading at like a 2 multiple with 35% returns. And the guy's like, no. I'm not investing in stocks. That's a fool's game. And the funny thing is, this guy actually worked at the company as his insurance company that Warren Buffett was recommending to him. And the guy said, no way. And it shows you the psychology of individuals when you have a golden opportunity right in front of you, 2 multiple stock, huge returns. You're working for the company, it's an insurance company, it's a cash cow, and you say no. That is the danger of appreciation, because appreciation is basically this foolish mentality that I'm going to follow the herd. Whatever the herd does is what I'm going to do. And when the opportunity, in fact, in performance is presented to you, you say, no, stock's a fool's game. I'm going to put my money elsewhere. What are your thoughts on Warren Buffett's idea around waiting for the right pitch?
Well, it's a perfect game for him. So his temperament enables him to simply sit there and wait and be patient until he finds a. And there's another gentleman who lives in China now who says great investments should be like walking upon $100 bill and simply simply bending down, picking it up, and putting it in your pocket. The best investments are no brainers. Like they're going to make you seem smart. Like when you do these and the results after 10, 20, 30 years, it makes you seem like you had this great insight, this great wisdom, this great knowledge, this great intelligence. The reality is the best investments are just absolute no-brainers. They're these perfect pitches at the perfect speed, right in your sweet spot, and you absolutely can tee off on it. And then you simply sit there and wait, and there's no strikeouts. There's nobody calling strikes. Now you could say, well, inflation. And we can get into that if we got time. We'll go into that. You can hedge against inflation, especially individual investors. You can hedge against inflation by lowering your lifestyle. Buy a bag of organic carrots and potatoes and apples and organic broccoli. You just reduce your consumption. If there's high inflation, switch to a product that doesn't have high inflation. There's no inflation in carrots right now. Switch to eating carrots and vegetables that are massively produced, organic vegetables, apples. You can totally hedge against inflation. So that's not really an argument that applies. Like there's all this there's all this inflation in diesel. Don't drive your boat as much. Don't drive your car as much. Walk more. You'll be healthier. It'll have zero effect in you. Putting your money to work, you have to do that. You have to have a pile of money. You have to go through this temperament process. You have to develop patience. You have to go, okay, I'm okay. It's not a great investment. Cash is a horrible investment over the long term, but I'm only going to hold this for 3 years or 5 years or 7 years or 10 years. I'm going to get my pitch. If I'm patient, I'm going to get my pitch, and it's going to be a no-brainer. Everyone's going to be running away from it, but the underlying economics, the fundamentals, the value of the business is going to be clear as day. That's a lot easier game to go into and trying to do data sets. I'll use a very specific example with Alan Greenspan because he's not in the game anymore. Alan Greenspan had data sets of bolt companies, companies that made bolts, nuts and bolts. And he knew based on this data that nobody else was looking at of the economy was expanding or contracting based on how many bolts were being manufactured over the last 3 months or the last 6 months or the last year. And he could see the economy based on bolts changing. And he had other data sets with trains and steel. He had insider knowledge, and he was using that not to buy that business. He wasn't going into buying train businesses, but he knew if he could get that data, and that's how he got wealthy. If you read the history of how Alan Greenspan got wealthy, it was extremely detailed, intelligent data sets. It wasn't day trading optimism or pessimism and trying to predict behavioral of people. It wasn't trying to predict behavior. It was based on extremely detailed information and data sets. And eventually he got out of that game. That's so much work when these guys do. There's a guy that lives in China that was very successful with it. There's another, Mr. Soros, George Soros was very successful with it. When these guys eventually get their money, they don't do that anymore because it's so much work. They go into easier games. The game that Warren Buffett plays is much easier than the game that Alan Greenspan used to play, George Soros used to play, and a gentleman out in China that I'm not going to mention his name used to play. Those gentlemen, all of them exited that game. They made their money and they exited. Those are kind of my thoughts. Warner, anything to add to that?
Great thoughts. We have about 20 minutes left in this podcast. And to add to what you're saying, we're differentiating two different mindsets, behavioral mindsets here. And what we're next going to talk about is the behavioral mindset behind an value investor. And then we're going to finish it off with the behavioral mindset behind someone who's focused on appreciation. And from what you said, juxtaposing Alan Greenspan to Warren Buffett, what it really comes down to is the value investors and the word itself. His or her behavior is based on focusing on what is value. That is the key component that builds the behavior of a value investor. And what that behavior starts with is performance. So they're always looking for what business, what entity, what asset is going to most efficiently produce cash. So if they produce a company, let's say at its lowest level produces $1, it keeps 30%. Well, a value investor is going to go, well, can I find a company that produces 31% or keeps 31%, keeps 32%, keeps 34%? So value investor is always focused on that underlying fundamental, which is what business is most efficient at keeping cash. And then the value investor is patiently waiting to say, hey, can I get that business at a really cheap price? When the appreciation guys are completely freaking out and dumping everything. And the reason the value investor has developed this behavioral mindset because they know over the long term, if you wait patiently for a business that is a 35% operating margin and you can buy it real cheap, your ability to make money versus the appreciation guy who's making money every bit of the way over the past 10 years, you can far surpass him with one buy in the next 10 years, surpassing what he made in the last 10 years. What are your thoughts on that, Mara, in terms of that behavioral mindset of buying cheap, buying highly efficient businesses, and the ability to generate way more cash than a guy who's appreciation guy who's buying it every step of the way up the chain?
It boils down to, like you said before, Warner, temperament. And how do you develop the right temperament? It's putting in the work. When there's nothing smart to buy, it's putting in the work and looking at deals and saying, no, there's not enough value here. It's weighing all these deals. It's continually doing the nug work, doing the pencil work to look at deals and weigh them out. Warren Buffett's constantly reading. He's constantly learning. The guy's monomaniacal about weighing business deals. And eventually he knows, he has enough knowledge to know that eventually the tide turns, people get into trouble, and there's an opportunity to literally load up on value. And he's shoveling. He doesn't have a shovel. He has a front loader. he drives a front loader out there and starts loading massive amounts of yards. For those folks aren't listening, in America, there's a massive Caterpillar plant in Peoria that has these huge mining pieces of equipment. That's what he's driving around. That's what him and Charlie Munger are driving around looking for. But the average guy can build a shovel. He can build a nice big snow shovel and go out there. And when there's value, if he has the right temperament, he can start shoveling that value onto his side of the equation. And because people lose faith, they stocks become unpopular, or businesses become unpopular, or single family houses will become unpopular, or even multifamily real estate becomes unpopular. There's this pendulum swings between optimism and pessimism. That's predictable. That's actually predictable human behavior. That's happened forever. Read the old classics, read the Bible, read history. People swing between optimism and pessimism, and that affects prices of businesses or prices of assets. And there's going to be deals. Just have faith, be patient, have the right temperament, and stack a bunch of cash up. That's hard. It's so easy to say that. It's hard to do that. I get caught thinking, well, I got to do something with my cash. I got to do something with my cash. No, I just need to live a little. If I'm worried about inflation, I just need to live a little bit lower to the ground. That's all I have to do, and just be patient. What are your thoughts on that, Warner?
It's really about consistency. The value investor has a consistent mindset. I know you and I over the years have really hammered this point, which is you stick to the benchmark. Okay, Oracle, 30 to 35% operating margin. Can I get equal to that, or can I beat that? And we've talked about before, if we're buying our own private businesses, we can take that operating margin down because we own the actual business, and we're going to expand those sales rapidly, and we're going to make a lot on the expansion of those sales because the delta of the revenue is changing so much and we have such a piece of the pie. But that's a different situation. Just from investing and return, if you just focus on consistency, which is here's my metrics, 30% operating margin, I'm willing to buy it at this multiple, and I'm looking for this return on my invested capital. If you just hold fast on those fundamentals and do that over 40 years and you stack cash and wait for opportunities, you will do really well. Versus the flip side, if you focus on timing this pendulum up and down, or you get caught at it going up and you invest money because you think it's just the next guy's going to bid it higher and the next guy's going to bid it higher, there's what you're really dealing with, there's no margin of safety because you just bought an asset. You have no idea the value of that asset, and you're saying, well, I think it's going to go higher. Whereas the value investor is going, I know the value of this asset. I know it's run well. I know it will give me money. I know it makes a lot of money, and I'm going to buy it at a good price. So I think that's the key, is consistency and knowing what your underlying fundamentals are.
Absolutely. Consistency is just as equal as temperament. It's like going back and forth between strategies or jumping between investment approaches is horrible. It's a horrible thing to do. It's a horrible way of actually making the right moves. Being consistent, having the checklist, doing the due diligence, looking at a hurdle like Oracle is a great hurdle to have. Is constantly measuring everything, a benchmark. You're constantly measuring it against everything else. Here's this wonderful business out in California, which really is global nowadays. If I can buy that for a reasonable price, I shouldn't do anything else. The only time to do something else is when I can't buy that for a reasonable price, and this makes a lot of sense when I weigh it out. And having the temperament and that decision matrix / due diligence checklist and working through the numbers and going, this is actually a great investment. There's phenomenal value here. And eventually I'll be rewarded. I never have to sell it. I'm in no pressure to sell this thing. It's not going to go out of business. It's a wonderful business. I buy it and I sit on it and I wait. And eventually people will recognize the value. Like I said, initially it's popularity, on both extremes, optimism, pessimism. But over a long enough period, people weigh that out and they see the value. The value becomes apparent to everyone. They go, no, that's a phenomenal business eventually. And it will appreciate. If you're patient, it will. If it's a phenomenal business, there's nothing that's going to last forever at a low price. If it's really a phenomenal business, trust me, it'll be weighed out eventually and people will recognize it for what it actually is. But in the short term, people get overly overly pessimistic on different asset classes, and they don't want anything to do with them because there's probably some people that are losing. Like the S&P 500 is going to go through a huge. There's companies that are basically walking zombies. They're zombie companies, and they're going to get flushed out of the S&P 500. Years ago, I don't want anything to do with the S&P 500 mutual fund I own, and they're dumping it. They're going to dump all 500 companies. Well, there's some real gems in there. Well, we just said Oracle. If you dump enough mutual fund shares, well, they got to sell all the stuff. They're selling the good and the bad. They're dumping out everything. They're dumping the baby out with the bathwater. And there's guys that'll come in there, they'll swoop in and they go, no, you're wrong. Oracle is not a bad business. It's a wonderful business, and it's trading at a ridiculously low price. It's trading like a laundromat. I can't go down the street and buy the laundromat that's been in business for 30 years for that price. The owners, the hardworking immigrants that run that laundromat won't sell it to me for the price I can go out and buy Oracle, and Oracle is the better business.
So taking a look at the final point, which is appreciation, because you just described it really well, the S&P 500, and there's like mutual funds and other individuals just dumping their shares, and great companies like Oracle and other companies are being dragged down with it. Let's really take a deep dive into the mindset behind appreciation. So to give you an example, let's just look at a normal business decision that we've probably all made in our life. Let's say you own a real estate asset and you're hiring a gardener or a landscaper to come over and do, let's say, some weekly landscape on your asset, right? This individual charges you, let's say, $25 an hour. He's there for 4 hours, it's $100, right? Well, he does this he comes every week, does your landscaping. Let's say you're out in California, it's a great environment. The plants grow fast, so every week he's there. And after about a month or two, he comes back and goes, hey, my price is now $200 for that 4 hours. So it went from $25 to $50. I know what you're going to think in your mind, what I'm going to think in my mind, which is, why am I paying this guy double? He's now making double of what he used to make. I'm not going to hire this guy anymore because he's $25. Now he's $50. No way, dude. You're gone. You're fired. I'll hire someone else who can do it for $25 to $30, right? Now, the reason why that decision is important is because when it comes to appreciation, that decision gets thrown out the window. He says $50, you said, yeah, I'll pay you $50. He says $75, yeah, I'll pay you $75. And why I say that is because that's what people are doing with stocks. Oh yeah, I'll pay $1,000 for Tesla. I'll pay $1,500 for Tesla. But when it comes to your local gardener or landscaper and you're making a business decision on price, you're going, no, I'm not paying you $50. So that's the insanity of appreciation. You'll make decisions in your life that are simple business decisions. But when it comes to buying, say, a stock like Amazon or Pinterest or whatever the new fad is, you're just going to buy it. Oh, I'll pay $50 for that. Do you know what the underlying cash flows are? No. But you'll make the same decision, a different decision with your gardener. Oh, he's charging $25, he's charging $50. No, his time's not worth double the revenue that he's going to make. What are your thoughts on how this cognitive disconnect, on how you can make this like normal business decision in your own life running your assets, say your personal assets like a house, but then when it comes to appreciation of a stock market business, it all goes out the window?
That's an excellent analogy about the gardener doubling his prices, and you're going, okay, I'm gonna look for a lower cost provider of this service. I'm not going to chase this higher. I'm not going to chase this optimism. Apparently, he thinks he's worth twice as much he was last week. Is he doing twice as much work? There's what you instinctively realize in your brain without even doing the math. You're like, is he actually going to produce twice as much value for me? Or can I get this somewhere else? Can I get the exact same value from another gentleman who provides a landscaping service? It's an excellent analogy. When we go into appreciation, chasing appreciation, it's basically trying to predict more people are going to be optimistic down the road than they're currently. And again, what the wise man does at the beginning, the fool does at the end. So the wise are getting into these speculative things initially. They've done the value, they've done the venture capital. The company's gone public. They just had enough shares to get to investors' taste for the company wet, and the shares took off because there's a limited supply. The actual founders haven't dumped a bunch of shares onto the open market. The company hasn't raised a bunch of money or capital through issuing shares, and the price goes up, and people realize that. And human nature being what it is, there's a fear of missing out. The price is taking off. I can get in, even if there's, I know it's not really worth anything. It can't be. It doesn't make money. They think, well, I can get in and I can get out in a quick enough manner that I'll make some money. It's like it's a total gamble. The better strategy is to be patient. Even if that's a great company, it'll eventually crash, like eBay or Amazon. There's any company you look at, there's always a time where it's been cut in half. The price has literally been cut in half. There's optimism and the price drops in half. You can look at all of the great businesses that become publicly traded companies. If you go out 5, 10, 15, 20, 30 years, you'll find a buying opportunity where that business was cut in half. It's a great business. It's a bad investment at a high price, and it's a great investment at a low price. And there's a time to buy it, and that's when everyone's pessimistic in the market. There's, as they say, quote unquote, there's blood in the streets. Nobody wants to touch anything. That's when you come in and you start loading up. You get out your snow shovel and you start doing work. You're out there every day chipping away, making some dents in that snowpack, and you're shoveling in that value onto your side of the balance sheet.
So here's what this all points to. In the end, it's all going to rebalance back to the fundamentals. It's only a matter of time. So there's the difference between two mindsets. There's the value investor who focuses on the fundamentals and being consistent in his focus. And then there's the guy or gal that's focused on appreciation. And that's based on ding, ding, ding is emotion. So these two behavioral mindsets we've been talking about this entire podcast is, are you focusing on performance, fact, consistency, being persistent, or are you focused on your emotions? And as we know, between you and I, let's just give an example, building a podcast. Some days we're like, wow, this is so much fun. And then some days we look at our stats on our YouTube and we're like, oh my God, we're getting nowhere. So if we were to rely on our emotions, I wouldn't even be talking to you tonight, right, Mario? Because we have 6 subscribers and a few hundred views. so if I was focused on emotion, I would say, Mario, what's the point? Let's stop talking. But we're focused on getting to a certain number, on impacting a certain number of people, and we're obviously in the discovery of that. My point is, when you focus on emotion, it's this up and down roller coaster. And when you do it in your own life in certain areas, you can see the impact. The challenge is whether it's in the stock market or an asset, and I've been calling this myself, what they're really selling you in the stock market or any other assets is they're selling you this story. Now, your job, depending on which side you choose, if you choose fundamentals, your job is to decide, is that story an accurate story based on the fundamentals? That's your decision you make if you're a value investor. If you're focused on appreciation, you just fall in love with the story and you don't validate that story. We have only a few minutes, about a minute and a half left, Mario. You finish it out. What are your thoughts on finishing out on validating the story when it comes to appreciation?
I think the story is a great example, Warner. There's an analogy of not catching a falling knife, and that's horrible advice. Again, look at the story. Oh, this whole thing is garbage. Don't ever buy the S&P 500. Don't ever buy the publicly traded companies. It's all the stock market's crashing. Don't buy. When you look at the story, the narrative, and you weigh the value of a business, Oracle, and you're not working off of, as you said, emotions, you're working off of logic and reason, and you're weighing out the business, you're saying this story doesn't make sense. Everyone's saying this thing's crashing. You're like, it doesn't appear to be that way with this business. This business is way better than a laundromat, and it's trading at a 7.5 multiple of operating income, has little debt, has a ton of cash on the books. Doesn't make sense. That doesn't make sense to me. I can't go buy a laundromat for that price. A story's wrong. The narrative is not what the business is doing. That's what the media and that's what optimism and pessimism is telling you, is that story. The real value is weighing out the business and their performance. You're going to get very wealthy doing that over a long period of long, healthy life. You'll have plenty of money to pursue your passion projects. Great podcast tonight, Warner. I appreciate your time.
Yeah, same here, Mario. I appreciate your time, and thank you so much.
Thank you for listening to the Red to Black podcast. We really appreciate you taking time out of your day to listen to our podcast. If you would like to connect with us in the future, you can find us on LinkedIn. Simply search for Werner Minchell or Mario Parzino. Also, you can find a link to our LinkedIn profiles in the profile section of the podcast. Thank you again for listening, and we look forward to connecting with you in the future.